Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 2-3 question number 1. This is Paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for the paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. The company accountant of JPLC had prepared draft financial statements for the year ended 30 June 2024. The following balances remained in the books of accounts. We have 6% bank loan, which is to be repaid in the year 2024, which is the current year. So this will now be a part of our current liability, not the non-current liability, because we have to repay it within 1 year. Then we have the bank, inventory, other payables, other receivables. We have our non-current assets, plant and equipment and property. We have the retained earnings, share capital, and in this case, the par value is 1. We have the share premium, taxation, trade payables, and trade receivables. The draft statement of profit or loss showed a profit for the year of 83,250. It has since been discovered no account had been taken of the following errors and omissions. Okay, before we dive into this additional information, let's take a look at our first question. We need to calculate the corrected carrying value of property at 30 June 2024. Carrying value just refers to the net book value. So we need the corrected net book value. So we need to look for the information that deals with the errors within our property, and that is given by information 5. The property was purchased on 1st July 2021 and had been correctly depreciated for each of the 2 years ended 30 June 2023 using the straight line method at 2% per annum. However, the depreciation charge on the property for the year ended 30 June 2024 had been incorrectly calculated using the reducing balance method at 10% per annum. Okay. So the property was purchased 3 years before the date of 30 June 2024. So we have our first year, second year, third year. Now the correct depreciation would have been using the straight line method at the rate of 2%. So that is just going to be 2% times the cost of property. And the cost in this case is 60,000. So the correct depreciation charge for the year would be 60,000 times 2%, which results in a value of 1,200. Okay, so for all 3 years, the depreciation charge should have been 1,200. But what we did for the third year is that the depreciation charge on the property for the year ended 30 June 2024, which is the third year, had been incorrectly calculated using the reducing balance method at 10% per annum. So this incorrect depreciation for the third year is calculated at the rate of 10% using the reducing balance method. So in order to implement the reducing balance method, the first thing we need is our net book value. And in this case, the depreciation charge for years 1 and 2 will act as our accumulated depreciation. The cost was given to be 60,000 minus 1,200 minus 1,200. This will give us the net book value times 10%. This gives the incorrect depreciation for the year to be 5,760. The correct depreciation was 1,200. So clearly, in this case, the depreciation is overstated. And overstatement is done by the amount of 5,760 minus 1,200. So the depreciation had been overstated by the amount of 4,560. And for the first part of this question, we only need the correct carrying amount. So the carrying amount after year 3 at the end of the third year will just be the cost minus the accumulated depreciation. And in this case, the accumulated depreciation will be 1,200 for 3 years. Let's calculate. So 60,000 was the cost minus 1,200 for 3 years. This will result in the correct carrying value of property at 30 June 2024 to have the amount of 56,400. Now for the second part, we need to calculate the revised profit for the year ended 30 June 2024. In order to calculate the revised profit, we always start with our draft profit for the year. Okay, we have been given the value for the draft profit to be 83,250. Now we just need to correct our list of errors. Let's start with the first one. closing inventory had been understated by 2000. If something is being understated, we have to add it back. And in this case, we're talking about closing inventory. While preparing our statement of profit or loss, the closing inventory is subtracted within the cost of sales. But in order to get our gross profit, the cost of sales is again subtracted. So that's a double negative, which results in a positive. Then we have a positive and a positive, which is again a positive. So it just means that in order to correct the first error, we need to add back the amount of 2000. And this is the error which relates to our closing inventory. So closing inventory, we add back 2000. That's all for the first error. Now for the second one, administrative expenses included an interim dividend of 3% that had been paid on 1st April 2024. Remember that dividend should not be included within our statement of profit or loss. It will only be a part of our statement of changes in equity. So that is incorrectly included within our administrative expenses in this case. We first need to figure out the amount of dividend, and the rate in this case is 3%. So whenever we have been given the dividend rate as part of percentage, we just need to multiply it to the share capital value instead of the number of shares. So the interim dividend in this case is just going to be the share capital value, which is 70,000 times 3%. This results in the value of 2100. So this was incorrectly included. So we can say that the administrative expenses was overstated. If something is overstated, we have to subtract it, and in this case we're talking about administrative expenses, which itself is again subtracted in order to get our profit for the year. So two negatives will make up a positive. It means that in order to correct this error, we just need to add back the amount of 2100 to our draft profit. And this is the error for administrative expenses, or we can also label it as interim dividend. We add back the 2100. That is all for the second error. Now for the third one, an amount of 1250 prepaid on distribution costs had been treated as an accrual. So we can split this into two different errors. The amount was actually prepaid, but we did not include it. So we can say that the prepaid distribution cost was understated, and it was instead treated as part of our accrual, but there was no accrual. So we have overstated the accrual on the distribution cost. Let us first correct the error for understated prepaid. If something is understated, we have to add it. And we're talking about prepaid expenses at the closing date. Always remember that the prepayment at the closing date will be subtracted. And in this case, we're talking about distribution costs. So in order to figure out our profit, distribution costs will be subtracted. So that's a positive, negative, negative, which results in a positive. So in order to correct this prepaid understated, we need to add 1250. Now let us correct the accrual overstated. If something is overstated, we have to subtract it. And in this case, we're talking about accrual at the closing date. Always remember that the closing accrual will be added. And again, in this case, we're talking about distribution cost, which is subtracted in order to figure out our profit. So that's a negative, positive, negative, which again results in a positive. It just means that in order to correct this error of overstatement of accrual, we just need to add back 1250. So in total, we will have to add back 1250 twice, which results in the amount of 2500. Let's write it down. So this is for the distribution cost. We're adding the amount of 2500. That's all for the third one. Now for the fourth one, the 6% bank loan 2024 had been repaid on 30 June 2024. So this repayment of the bank loan will have no impact within our profit for the year. So we can just ignore this information for now. Then for the property, we've already concluded that the depreciation was overstated by 4,560. Now, if something is being overstated, we have to subtract it. And in this case, we're talking about depreciation, which is a part of our expense. So the depreciation will also be subtracted in order to calculate the correct profit. Negative, negative, which means that it will be a positive. So it just means that in order to correct this error of depreciation being overstated, we need to add the amount of 4,560. Let's write it down. This relates to property depreciation. $4,560. Okay. Then for the sixth information, the taxation liability at 30 June 2024 had been overestimated by 3,000. Overestimated just means that it was overstated. So if something is being overstated, we subtract it. And in this case, we're talking about taxation. Taxation is always subtracted in order to calculate our profit for the year. So that's in double negative, which results in a positive. So we just need to add back the 3,000 in order to correct this error. Let's do that. This is for taxation. We add 3,000. Now if we add it up, we will get our revised profit for the year. Okay, that's just going to be 83,250 plus 2,000 plus 2,100 plus 2,500 plus 4,560 plus 3,000, which results in 97,410. And in this case, we have been given the working section as well. So all of the workings that we did should be shown within that particular box so that you get your markings correctly. That's all for the second one. Let's move towards the third one. We now need to prepare the statement of financial position at 30 June 2024. We need to use the space provided on page 5 to show our workings. Okay, in this case, I'll just do the workings within the insert itself. So let us start with the assets section. For assets, we start with non-current assets. And in this case, we're talking about limited company. So we can just show all of our non-current assets under the heading of property, plant and equipment. And always remember that when showing our non-current assets within the statement of financial position, we record its net book value. So we need the correct net book value. And in this case, within the first part, we've already calculated the correct carrying value or the net book value for property. So to this value, we just need to add the carrying value of the other non-current asset, which was plant and equipment. Okay, and remember that these are the information at the closing date. So we can just calculate the net book value by subtracting this provision for depreciation from our cost, 137,000 minus 66,940, which results in our net book value for the plant and equipment to be 70,060. Let's add it up. This results in the value of 126,460. Let's write it down within our statement of financial position. 126,460. That's all for the non-current asset. Now we need to move towards the current assets. Okay. For the current assets, we have trade receivables, then we have other receivables, and we have bank, as well as the inventory. Remember that we are talking about a limited company. For a limited company, we always need to show trade receivables and other receivables together under the heading of trade and other receivables. And in this case, we had additional information. So let us adjust that as well. Remember that inventory was understated. So we need to increase the value of inventory by 2,000. So plus 2,000. This results in the value of 85,900. Then we have the prepayment of 1,250. Remember that if we are prepaying the expenses, it means that we are now yet to receive the services for it. So that will act as our other receivables. So 1,250 will now be included as part of other receivables. And previously it was included as part of accruals. So accruals would be a part of other payables. That was incorrect. So we need to remove 1,250 from there. Let's calculate the correct values for other receivables and other payables. For other receivables, that's 5,320 plus 1,250, which results in 6,570. For other payables, that's 3,150 minus 1,250, which results in 1,900. Okay. Then we have the bank loan, which had been repaid. So if we are repaying the bank loan, it means that the amount will be gone from our bank account. So we need to remove the amount of bank loan, which is 11,000, from the bank balance, minus 11,000. So the new bank balance will be 1,980 minus 11,000, which results in the negative value of 9,020. So now this becomes the bank overdraft. So this will no longer be part of our current assets. We need to show it as part of our current liabilities. Okay, then we've already adjusted the property value towards the carrying amount for our property. Then we have the taxation liability, which was overstated by 3,000. So we need to remove 3,000 from taxation. So this results in the correct value of 10,600. Okay, we were preparing the current assets section, so that will only include the trade and other receivables. and inventory. Okay, we already have the value for inventory, 85,900. Now we need the total for our other receivables and trade receivables. So 32,680 plus the other receivables of 6,570. This results in the value of 39,250. Let's write these two down. Okay, we first have inventory. The revised value was 85,900. Then we have our trade and other receivables. We calculated the total to be 39,250. Let's calculate the total for the current assets. That will be 85,900 plus 39,250, which results in 125,150. Now we need to calculate the total assets. That will be the total non-current assets plus the total current assets. So 126,460 plus 125,150, which results in 251,610. Now we can move towards equity and liabilities. We first start with equity. Let's take a look above. And for equity, we only need to change the value of the retained earnings. Okay, we need to add our profit for the year to the given value of our retained earnings. And in this case, we calculated the revised profit to be 97,410. Okay. And previously we had the draft profit of 83,250. So what we need to do is we need to remove the previous profit. So from our retained earnings, we will subtract 83,250, then add our revised profit, which we calculated in the second part, which was 97,410. This results in the value of 136,460. And there was another error relating to the interim dividend. We removed the interim dividend from our statement of profit or loss because that should be included within our statement of changes in equity. And how we deal with dividend is that it will always be subtracted from the retained earnings. So we need to remove this 2,100 as well. This results in the value of 134,360. This is the value to be included within our statement of financial position. Then the share capital will be recorded at 70,000. Then we have the share premium of 4,280. Those are the only three items within equity. Let's write it down. So we first have the share capital of 70,000. We then have the share premium of 4,280. Then we have our retained earnings, which was of 134,360. Now we need the total for our equity. That will be 70,000 plus 4,280 plus 134,360, which results in 208,640. Okay, then we need to list our liabilities. And in this case, I don't think there is any non-current liability because the 6% bank loan does not exist since it was repaid at the closing date. The current liabilities will be our bank overdraft of 9,020. Then we need to add the trade payables and other payables together. So 21,450 plus the other payables of 1,900. This results in the total trade and other payables to be 23,350. Then taxation will not be paid during the year, it will be paid in the next year, so it will also have to be shown within our current liabilities, and the revised value for taxation is 10,600. Let's write it down. So we have the current liabilities. We first have taxation of 10,600. Then we calculated the trade and other payables, which was of 23,350. Then we also calculated our bank overdraft, which was 9,020. Now we need the total for our current liabilities. That will be 10,600 plus 23,350 plus 9,020, which results in 42,970. Now we need our total equity and liabilities. So that will be the sum of our total equity and total current liabilities, 208,640 plus 42,970, which results in 251,610. Okay, and in this case, we can see that the total asset is equal to the total equity and liabilities, which means that our statement of financial position is correct. That is all for the third part. Let's move towards the next one. And remember to show all of the workings that we did within the insert within this particular box so that you get your markings correctly. Now we have some additional information. The directors of JPLC are aware that one factor causing the value of plant and equipment to depreciate is wear and tear. We need to state two other factors that may cause the value of plant and equipment to depreciate. The second factor will be time factor. With the passage of time, the value of our non-current asset will decrease. And another one will be the uses. Once we use our non-current asset repeatedly, the value will definitely decrease. That is all for the fourth part. Let's move to the next one. We need to state the formula for each of the following ratios. The first one is profit margin. This is quite easy. This will just show our profit as a percentage of the total revenue. So that is going to be profit for the year divided by revenue, and we need to show it in terms of percentage, so times 100. Then we have the return on capital employed. So return on capital employed will show the return, which is in the form of profit from operations, by utilizing all of our capital employed, which is the sum of our equity and non-current liabilities. So that is just going to be profit from operations divided by the capital employed. Capital employed is just the sum of the equity and non-current liabilities. And again, this will be shown in terms of percentage as well, so times 100. That is all for the fifth part. Let's move towards the next one. We have been given some additional information. Having calculated both these ratios, the directors are pleased that both achieve the company's targets. They are wishing to expand and are planning to acquire additional plant and equipment with an estimated cost of 80,000. They are considering two financing options but are also concerned as to the effect that these will have on the ratios. Option 1 is to request a 5-year bank loan to purchase the equipment outright. Option 2 is to take out a 3-year lease agreement for the equipment. So within option 1, we will just purchase the entire equipment that will be required. Under option 2, instead of purchasing the equipment, we will just rent it. That's the lease agreement. Now, we need to advise the directors which option they should choose. We need to justify the advice by considering both financial as well as the non-financial factors. Okay, this is of 7 marks. So we need 3 comments for option 1, 3 comments for option 2, and a final decision. Let's start with option 1. And we need to include both the financial as well as non-financial factors. And we also need to frame it such that we are including both the advantages and the disadvantages. Now, the very first advantage of option 1 is that since we are outright purchasing the equipment, the company would have ownership of the asset. Let's write it down. The company would have ownership of the asset. Then for the financial factor, since we are requesting a 5-year bank loan, we will have to pay interest on it. And due to those interest payments, the profits will be reduced. Let's write it down. Interest payments would reduce profits. Then the question was also framed in a way that they are considering the financing options but are also concerned as to the effect these will have on the ratios. Now, the ratio that will be affected in this case will be the return on capital employed, because remember the formula for the return on capital employed is profit from operations divided by the capital employed. This is just the equity plus non-current liability. If we are taking out a 5-year bank loan, it means that our non-current liability is increased, so the denominator factor is increased. And for any ratio, if the denominator is increasing, the overall ratio will decrease. Let's write it down. It is likely to have a negative effect on the return on capital employed. Okay, that's all for option 1. Let's move towards option 2. Within option 2, we will be taking out a 3-year lease agreement for the equipment. So the very first disadvantage would be that the company would not own the asset. And for a lease agreement, we will have to pay out the lease payment, which is similar to the rental payment that we do if we are renting anything out. So the rental payment would decrease our profit for the year. Let's write it down. Lease payments would reduce profits. Now, due to the reduction in the profit, if the profit for the year is decreasing, then the overall ratio will also decrease unless we are able to generate a higher revenue. Let's write that down as well. It may have a negative effect on profit margin unless significant increase in revenue. Okay, now based on these factors, we need to make a final decision. So in this case, the amount that we are considering is 80,000, which is a pretty big amount. So if we were to take out a 5-year bank loan, then it means that if there is some downturn in the business later on, let's say that the business will turn into a loss in the future, then the company would be in a very risky position because they are still yet to pay the bank loan, which is a non-current liability of 80,000. But in case we take out a 3-year lease agreement, it will be less vulnerable to business downturn because for the lease agreement, we do not have to pay back the loan amount of 80,000. We only have to pay back the lease payment. So that would be quite an advantage. So I would advise the directors to go ahead with option 2. The directors should choose option 2 as it is less vulnerable to business downturn. Alright, that's all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.